want to get to credit, but just on this strong dollar issue and the amount of attention and weight that Powell carries off a speech like this, are you concerned systemically or globally about some of the fallout?
I think we've all been worried about a slowdown in the economy, but frankly, I'm not particularly surprised at what's happened in the last few days. I was pretty out of consensus when I was last on this show because Powell had made some very dovish kinds of comments, and I think that those were overinterpreted. The cost to the Fed of underestimating the impact of inflation, backing off, and then having to go back on to hit the brakes again would be enormous, both in credibility and in effectiveness. And I think part of the Fed chair's job is to jawbone down people's expectations so they start reducing their own consumption, so that job openings start to reduce a bit. And so there's a bit of a slowdown that takes place, not just because of interest rates actually going up, but because of the anticipation of the effects of that. So I'm not terribly surprised that this is the trajectory of the market at this point.
So you were right that the relief, I guess, was misplaced. But do you see a lot more pain for the equity and bond market now that it's starting to reverse?
Sometimes I think the markets tend to overreact in both directions. I think the Fed oversteered a lot when they were easing up, and it produced the opposite effect, where it accelerated inflation. And I think at this point, it's more likely that the Fed oversteers by maybe increasing a little bit too long and a little too hard, and maybe selling down its balance sheet a little too hard, just to show how serious it is in the fight against inflation. But I think we have to be a little bit humble and recognize that the Fed is really only part of the equation. The Treasury has a role in this as well. And federal spending and the state of the deficit, these are also ingredients in inflation. And if you spend well beyond your means, you also stimulate inflation. So we tend to give a lot of effect to the words of the Fed chair, but we recognize that that's really only one ingredient.
But to your latter point, that they're going to overdo it potentially on tightening and trying to control inflation, what sort of stress in the system do you see, or fallout for the economy do you see as a result?
I see it as more of a sustained malaise as opposed to a really deep, spiky recession. And I guess the reason for that is we're coming from a position of great strength in the sense that the bank's balance sheets are incredibly strong right now. The consumer has nice amount of savings relative to income flow. And we're starting with a lot of open job positions. And we're starting with a relatively strong stock market. So the economy is in a position to be able to take it in a way that it would not if it were in a more fragile state. So I think that at some point this gets reversed. It could last a little longer. It could be a little more painful. We'll certainly see the effects on it. Many companies have borrowed heavily and have relied on low interest rates and have not fixed their rates. The effects of significant increases of rates will be lower earnings, and that will have a feedback effect on the stock market as well. It also affects the government's ability to spend money when its own cost of money is quite a bit higher and its debt balances are higher, so it won't be able to spend as much money quite as easily. So this will reverberate, but I tend to see it more as getting to a certain point and persisting, as opposed to getting very spiky and really throwing the economy into a terrible position.